Good day, my name is Dean Crocker and I'll be taking you through our latest EIA report released on FirstRand. On the 4th of March 2021, FirstRand released their first half 2021 results, in which they released, I'd say, relatively flat results. Net interest income and non-interest income were both relatively flat in terms of their earnings compared to the previous period. Total revenues remained flat to about 54 billion rand. Pre-provisioning operating profit did however fall by 2% to 25 billion rand, impacted by slightly higher expenses, and you'll see it in the cost-to-income ratio, which increased from 51.1% to 52.2%. The group, however, remained impacted by high impairment charges, which were expensed through the income statement. They increased by 59% to 9.4 billion, resulting in ECL on balance sheet of 4.2% relative to 2.8% in the previous results. In terms of performance coverage ratio, this increased from 1.97% to 2.09%. Total deposits continue to show nice growth, increasing by 8% to 1.56 trillion. However, advances remained relatively flat at 1.22 trillion. This is showing relatively the conservativeness of the group, in which they're not lending out at the same rate as which they are receiving deposits. Thus, their revenue or their top line will continue to remain under pressure so long as this continues. It also implies that they potentially are not too sure if they're able to collect on all the money they lend out, and would thus rather like to pull back on lending activities and maybe refocus the money on better capital allocation. In terms of the balance sheet and the statutory requirements, Tier 1 capital ratio declined marginally from 13.2% to 13.1%. This is over improvement from full year 20, which is at 12.1%. Tier 1 leverage ratio also declined from 7.7% to 7.3%. Ultimately, the return on average assets remained under significant pressure, falling from 1.66% to 1.14%. Now, this is relative to a really low interest rate environment right now, and a lot of pressure coming through on the deposit base. The return on common equity also declined significantly from 21.2% to 15.6%, which is quite material in FirstRand's world, as they are and have historically shown higher ROEs relative to other banks given their business model. It also implies that there's a greater re-rating that could apply to them should they not continue to deliver sound results. In terms of the impact on date of release, the share price of FirstRand was up 2.54% to 53 Rand relative to the JSE Cap Swix, which closed marginally lower, implying that it was really favourably met by the market. Since the beginning of the year, FirstRand has, however, underperformed the JSE Cap Swix by 4.7%, with a total year-to-date performance of only 7.2%. On a price-to-book value basis, the group is trading at a 19.1% discount to its 5-year average of 2.3 times, but at a significant premium relative to its FactSet peers. This is relative to historical premiums, where it always trades at a higher value to its peers based on its high ROE. But in the next page, you'll see how I talk just relative to the actual overall comparison. In terms of the valuation, the group does scream fairly valued. The sector has come under significant pressure in the last 18 months. They were directly impacted by COVID, and they will continue to be impacted by COVID, particularly given the high unemployment rate in the country. And the collectability of their loan book remains under pressure, and you've seen it in the higher provisioning ratio, which implies that on an IFRS 9 basis, which is really a lot more aggressive provisioning methodology relative to the old accounting standards, that they will continue to be impacted. Unfortunately, this doesn't bode well for the group, but we do suspect that management may have taken on greater provisions, really as a management tool. They are conservative by nature, they are bankers, so they will be conservative by nature. Thus, there may be some potential releases in the near future once the economy starts to settle and stable, and we start to see a bit of normalization coming through in the employment numbers. FirstRand, however, has always attracted a higher price-to-book ratio relative to its peers. As I mentioned, generally it's about 87.5% premium to its peers. We're currently at over 100%. And this is really due to its high historical superior ROE. It's given their business models a bit different to the other banks. This is really what is a differentiating factor. If you just take note of the two graphs on the right-hand side, it will be relevant to the discussions around the provisioning numbers and the increase in the credit loss ratios. It is really just based on the IFRS 9 stage allocation and provisioning ratios. You can see that in December 20 relative to the other periods, that the provisioning ratio, which is relative to the right-hand side y-axis, has slowly increased year on year, or period on period better. And there's a real shift in the allocation between the three stages. As you can see in December 20, there's a significantly growing, call it stage 3 relative to December 19, as well as stage 2. And all that is it's almost like an aging analysis. In stage 1 loans are those loans that are performing, and you'll generate the highest maximum return off them with the lowest provision. In stage 2, the guys are starting to gain a bit of risk. And then stage 3 is just the guys that are potentially at biggest risk of defaulting entirely, and thus you don't generate the most revenue of them. But they contribute the highest provisioning and value in terms of the group. So if there's any curing of brackets, would really improve on the group's basis. So in terms of the assessment, the group released a mixed set of results. They reflect very stagnant revenue growth, continually and significant pressure on the net interest margin. The total revenue line item has remained flat for a period of time now, and it's really attributable to the low interest rate environment as well as the high provisioning ratios. They could go to market and lend out a lot more money, but the old saying in lending industry is it's very easy to find someone to give money to. It's very difficult to collect it, and I think that's what you've seen in the financial sector at the moment, is that they're very conscious of capital preservation at the moment, and this is just resulting in a bit of a stagnant loan book growth, and only really lending out to the best of their clients. There's also a difference in the type of lending activities they are utilizing at the moment. And that is very reflective of that 59% increase in payment charges, which is probably historical in nature. The operating expenses remained relatively flat. There was a slight increase in the total cost ratio, but overall the normalized earnings are 11 billion, or about 21% lower year on year. Credit impairment charge increased by 59% to the 9.4 billion, which in their terms is an annualized credit loss ratio of 1.6% relative to 2.89%. This is different to the ratio that I quoted in the previous page, which is an on-balance sheet ratio. The balance sheet remains over well capitalized across the group. Their leverage ratio, which is very statutory in nature, remains sound, 13.1%. And net asset value continued to increase from 134.8 billion to 145.2 billion. Normalized NAV per share of 25 Rand 88 cents, if you want to call it that, relative to 24.02 cents. The interim dividend did decrease by close on 25% to 110 cents per share. And this is really just reflective of the group's position and some capital preservation going through. Total assets increased by 13.6% to 1.95 trillion. Advances remained flat at 1.22 trillion. This implies that there's a lot of money sitting in, either your marketable securities, your bonds, your cash, liquid assets in nature. Those assets that carry lower risk weightings, and also assets that aren't relatively influenced by non-collection in nature. Total deposits, however, increased significantly by 8.2% to 1.56 trillion. The derivative financial instruments within the group more than doubled. This is probably systematic of the COVID pandemic, and based on all of this, the group's biggest issue is they have historically maintained very high ROEs. They are seen as a bit of a growth counter within the financials industry. Thus, they attract that type of valuation and expectations in terms of return on equity. We've seen a significant drop in return on equity. We've seen that their business coming under significant pressure and may remain under pressure in this low interest rate environment. I think they have cut a lot of their costs to a large extent, and they'll bring a lot of the lending activities and practices in-house to ensure that credit loss provision does improve. But as it currently stands, we feel the share is probably well placed to remain neutral in terms of our recommendation. There are catalysts to it, and if the interest rate environment starts to pick up again, or the economy starts to improve significantly, we may see some upside on them. But as it currently stands, we feel that has to a large extent been priced in. There is still a lot of negative news around COVID-19 in the financial sector, which culminating with that low interest rate environment. It's a bit of a big headwind right now for the group. And on the back of that, I think we're happy to maintain our neutral recommendation. If you'd like to place a trade, please speak to your financial advisor. Alternatively, the trading desk is more than capable to assist you. Just take note of the disclaimer and have a great day. Thank you.